Hey, welcome to The Explainer. Today, we're going to talk about money. Specifically, where does it actually come from? Now, if you're thinking of a giant mint just printing out cash, well, that's really only a tiny part of the story. So let's get into it and see how the whole system really works.
So let's just ask it straight up. Where does the vast majority of money in our economy actually come from? Heads up, because the answer is probably going to shake up what you thought you knew about how banks and money work. Because here's the absolute kicker. Most money isn't printed at all. It's not physical, it's created electronically, out of thin air, inside our private banking system. So, how is that even possible? Let's dig in together. All right, so before we get to the how, we've got to tackle the what. To get how money is created, we first have to agree on what money even is. And you know, the answer itself is more interesting than you might think. You see, economists don't really define money by what it is so much as by the three main jobs it does. First, it's a medium of exchange. That just means you can buy coffee with it instead of, trading a chicken. Second, it's a unit of account, so we all agree a car is worth a lot more than a coffee. And third, it's a store of value, which just means you can hide it under your mattress and it'll still be worth something later.
Okay, but here's where it gets a little bit more complicated. It turns out that not all money is the same. Economists actually have to sort it into these different buckets, which they call monetary aggregates. And it's all based on one simple idea. How fast can you actually spend it?
Let's look at the two big ones. You've got M1, which is the super liquid stuff. We're talking physical cash and the money in your checking account. But then there's M2, which is way bigger. It includes everything in M1 plus all the money sitting in savings accounts and other deposits. And just look at the difference. The vast majority of what we call money in the economy isn't physical cash at all. It's just numbers on a computer screen. And that little detail, that's the key to this whole thing.
So you have all this digital money just kind of sloshing around the system. But how does the sheer amount of it actually affect, real world stuff like prices and jobs? Well, to see that connection, we need to look at this powerful, almost secret little formula that helps govern the economy. And here it is. M times V equals P times Y. It might look like basic algebra, but this is the quantity theory of money. And trust me, it's a huge deal in economics. Every single letter in this simple equation tells a massive story about our financial lives. So let's break it down real quick. First up is M. That's for the money supply. This is that big M2 number we were just looking at, all the physical cash plus all that digital money that's sitting in bank accounts. Next up, we have V for velocity. Think of this like the economy's pulse, or its heartbeat. It's just a measure of how fast a single dollar gets passed from one person to the next. If velocity is high, money is changing hands like crazy. If it's low, people are holding on to it. And on the other side of the equation, you've got P times Y. Now, this is just a bit of a fancy way of saying the average price of everything times all the actual stuff our economy produces, the Y for real output. The cars, the coffees, the computers. Put them together, and P times Y is simply the total amount of spending in the entire economy over a year. So why on earth did we just do all that math? Because it shows us something incredibly powerful. If the speed of money, V, and the amount of stuff we make, Y, are both kind of stable, then changing the money supply, M, has a direct impact on prices, P. To put it simply, in the long run, if you have a lot more money chasing the same amount of goods, prices go up. That's inflation. And that is why it is so critical to know where that money comes from. And now, for the main event. We know that most money isn't printed, it's digital. So where is it born? Well, the answer has been hiding in plain sight this whole time. It happens every single day at your local bank through a process called fractional reserve banking. Let's walk through this. Say you deposit $1,000 into your bank. Now, the bank is required to keep just a fraction of that. Let's say it's 10%, so $100 in its reserves. Then it lends out the rest, the other $900. Now, here's the magic trick. You still have your $1,000 available to you, but the person who borrowed the money also has $900 to spend, which they probably deposit in their bank. All of a sudden, the economy has $1,900 of spendable money, where there used to be only $1,000. New money was just created. And believe it or not, the cycle is just getting started.
There's actually a name for this incredible, mind-bending chain reaction. It's called the money multiplier. It means that the simple act of a bank giving out a loan doesn't just move existing money around, it literally creates new money in the form of new deposits that did not exist before.
So just how powerful is this multiplier? Well, with that 10% reserve rule, our $1,000 deposit can eventually become $10,000 in total money sloshing around the system. That's right, a single deposit let the banking system create $9,000 of brand new money out of debt. This is the engine of our modern economy. Okay, so if private banks are the ones creating most of our money every time they decide to give someone a loan, that brings up a massive question. Who is really in charge here? And that question leads us straight into one of the biggest, longest-running debates in all of economics. You've basically got two major schools of thought. On one side, you have the Keynesian view. They argue that in the real world, prices and wages don't change on a dime. They can be sticky. So they say central banks should be flexible and actively use policy to manage the money supply to help smooth things out and protect jobs during recessions. On the other side, you've got the classical and monetarist view. They argue that in the long run, money is neutral. It really only affects prices, not real things like jobs or output. They believe that stable, predictable rules for creating money are much better because they anchor everyone's expectations and prevent policymakers from accidentally causing even more instability.
You know, this quote just sums up the whole conflict perfectly. Is it better to have a flexible tool that lets you steer the economic ship through rough waters? Or is it better to have a predictable, steady anchor that holds the ship in place? Both ideas have huge pros and cons, and this debate is right at the center of how we run our economies today.
So we want to leave you with this final thought. Our modern money supply isn't really printed by a government. It's borrowed into existence by private banks. Its creation depends entirely on how much we as a society want to take on debt. So is this system a brilliant engine for growth and prosperity, or is it a machine that's designed for inevitable cycles of boom and bust? Once you really understand where money comes from, it's a question you can't stop asking. Thanks for joining us on The Explainer.